We have a phenomenal panel here today. We have Salvatore Ternullo from KPMG, John Davidson from OCC, Brent de Jong from Castlelake and Emergentech, Steve Utkus from Vanguard, and Rob Cornish from Gemini. So we look forward to this fantastic discussion. Thank you very much for joining us. And why don't we just start with a small introduction. Why don't you talk for 1 or 2 minutes about what KPMG or what your company is doing, what your role is in the firm, and how does that relate to fintech, for example?
Absolutely. So my role at KPMG sits within our consulting business. Obviously, KPMG has a breadth of services that we offer to the market, consulting, tax, and our audit practice as well. Within the consulting business, I run all of our crypto asset and digital asset services across a full life cycle of service offerings, from strategy through capability, design, development, implementation, and obviously risk, security, and compliance as well.
Well, I guess if we're going on the line, I'm Brent de Jong. I spend about half of my time with Castlelake. We're a registered investment advisor. We manage $15 billion. I run the special situations business, so do a lot of opportunistic investment, distressed debt investing. I'm also the chairman of Emergent Technology. We're a fintech company, 170 people across 14 offices around the world. We're tackling things like digital payments and how do you fix identity, compliance, connectivity, and a number of things in order to make payments work on a global basis.
Right. I'm Rob Cornish. I'm CTO for Gemini, so responsible for all technology within Gemini across our infrastructure, our application development, and all of our data management. We have offices in New York, Chicago, Portland, and we've just recently opened up in London. So manage the teams that help build the technology that supports Gemini. And our company is focused on buying and selling of digital assets, as well as storing those digital assets in a safe and secure manner. So that's what we do.
I'm John Davidson. I'm the Chief Executive Officer of the Options Clearing Corporation. We are the central counterparty for all of the options markets in the United States, as well as a number of futures markets. So our role as a central counterparty is to intermediate the credit so the central limit order book markets can actually function. We are, of course, very keenly attached to technology in general and financial technology as a designated by the Dodd-Frank Act systemically important financial market utility. Keeping up with the innovation that the exchanges we're responsible for providing service to is a key part of our function, and making sure that our technology is sufficiently flexible to enable us to do that.
Steve?
Steve Utkus from Vanguard. We are, of course, one of the leading global asset managers operating in a number of countries, managing about $6 trillion, I guess, as of today. My role at Vanguard is I oversee a small research team that studies investor behavior, and in particular studies it in a variety of platforms and defined contribution systems in various countries, on retail investment platforms, and increasingly we study digital interactions, much like social media or shopping networks will study digital interactions. We're doing that in the financial sphere. And that's actually how I met Alberto, discussing one of his papers on financial attention. But he and I are working jointly to study the dissemination at Vanguard, the reason why I'm on this panel, a hybrid robo-advisor that we introduced in the US in 2014. And we're doing some research on that.
Okay, thank you so much for self-introducing yourself. And so let me just start with some very broad questions. So when I think about fintech, in general, I think about robo-advising, blockchain technology, I think about machine learning. What among these kind of disruptive changes you think are going to have the biggest impact on society going forward? And anybody?
Sure. I'll start with just, I look at all three of them, and they're already beginning to make an impact in the society in their various ways. I'm obviously going to be a firm believer of blockchain, given my role, and obviously my reason for coming to join Gemini. My belief is that digital assets being able to be shared globally in a very efficient way where people can have ownership of those assets is really important to society. If you think about us in the US, we are very fortunate to have a number of ways that we can invest in different asset types and allocate, our resources. If you look more globally, that's not necessarily the case. And so as I look at blockchain and its capabilities, we see it as something that will help improve society if we can make that more readily available to others. And I give a lot of credit to also the robo-advisors and that technology, because I think it does something very similar in allowing people to have access to things that maybe you only had access if you had a certain size bank account or if you paid for a wealth manager. So some of these things I think are changing the way that we look at society as our society looks at these technologies. And then machine learning, I would also say that for us, we use that to help us actually with fraud detection. And when we're bringing on new users for AML and KYC aspects, we use some of the newer technologies to help with that aspect as well. We are a regulated cryptocurrency exchange. We have a New York Trust license, so we're not an unregulated exchange, which there's many of them out there. And we do have fiduciary responsibilities to our clients.
And I think in building on that and kind of hammering home, when we think about the disruptive potential of these technologies, we look at technology convergence. So I think you described a specific use case where Gemini is looking at on-chain and off-chain data and transactional information. And when we think about blockchain as a data layer, we look at how data is actually being consumed onto that data layer. And in the crypto space, we're looking at transaction processing. But if you think about this technology more broadly, you look at IoT breaking the pane between the physical world and the virtual world, and blockchain becoming that immutable data structure that facilitates more effective, efficient business intelligence, which is obviously derived from the implementation of machine learning algorithms. So I think the AML KYC use case is something that we've specifically done a lot of work on in developing proprietary analytics that are fit for purpose. But when you think about that technology convergence and that build of the next era of a tech stack, it's really the synergies that are created between those technologies that create the exciting promise and also the potential for disruption.
Yeah, I totally agree. It's that intersection where these technologies meet. Within Emergent, we have IoT devices, blockchain, and also AI, machine learning, and it's each of them are exciting in of themselves. But it's when you can pull it all together that you really have real trust and something really verifiable. And there's this is becoming much more of a theme kind of amongst us. We've launched a token, we call it G-Coin. It's 1 gram of a responsible gold kilobar. How do you know it's responsible gold? Because you have an IoT that says it is. How do you know that it's an AML person? Because you have the verification. So and we're a money transmitter company, so a little bit different, but very much the same space on things. And it's that intersection that we find is really the exciting point.
Okay, so let me take also a step even more, back even more. And so what are your views regarding how US is adopting new technology? So how do you think US is faring compared to China, for example? And what do you think are the greatest barriers to technological adoption in the US right now, for example?
Well, I think the U.S. is actually leading the world in that regard, and I think particularly in the financial markets, technology has been something that the U.S. has done and has really enabled our ability to preserve the deepest and most liquid financial markets in the world. I do think some of these technologies don't necessarily modify the fundamental operation of the central limit order book exchange markets. Blockchain, for example, is massively too slow to handle the transaction volume that we see on the New York Stock Exchange or NASDAQ. But they do offer some really unique opportunities to solve some fundamental problems. So I started also in 2 trading floors in Chicago, picking up executed paper orders off the trading floor and translating them so that a Hollerith card operator could actually input it into the computer system for, at that time, Merrill Lynch. So the technology has come quite a way since then. But if you think about distributed ledger technology for a bilateral market, right? Not one that has central intermediation, but it is institution to institution. And you think about the chain of investors. So you start with an asset manager, and you go to a custodian, and you go to a broker, and you go to the marketplace, and you go to the other broker, and you go to the custodian, and you go to the asset manager. And if each of them has a different version of the transaction, you're going to have a lot of people spending a lot of time ticking and tying and not really being productive. The notion of having a single accepted message throughout that chain, I think really can be transformative. But the thing about disruption, I grew up in Kansas, and they can't teach evolution there anymore, but the whole natural selection process in the financial markets, there's a lot more noise about disruption from distributed ledger technology that I think is realistic, but there are a number of very, very useful, both economically useful and socially useful applications for it. And institutions such as my own that are based on pretty old legacy technology that are changing have to be in a position. The gentleman from SIBO this morning talked about being on the bleeding edge. Well, I don't want to be anywhere near the bleeding edge of technology, but I want to be close enough to the leading edge that we can adopt as our various constituents, be they broker-dealers, clearing members, or exchanges, are adopting to these new technologies.
So I'm on the other side of that, where I love to be on the bleeding edge, and the work that I do is exactly on that edge. And when I think about, on a global basis, the regulatory environment specific to blockchain technology, we look international to China, and we look international to the European Union. In both of those jurisdictions, and just as examples, there are coordinated efforts across regulatory agencies to build defined structures that classify these assets and the legal entities that are engaging in those assets. And I think that the clarity from the regulatory perspective and the coordination from a strategic viewpoint, you look towards the EU. They've published a coordinated blockchain strategy with a funding mechanism that sits behind it, because they recognize the pace of innovation that's coming out of Southeast Asia with regards to some of these investments. So, obviously with the most mature liquid markets in the world, there's an additional layer of expectation and, control to guarantee investor protection and market integrity. And we have the most complex markets in the world. But I think that, as we look forward to the next 5 to 7 years, there's an opportunity, and the US regulators are there. We've had them in the room today. They recognize the opportunity to advocate for a more progressive approach. And I applaud Georgetown and the work that you're doing here, working with organizations like the Chamber of Digital Commerce to bring the academic lens around these asset types and this technology to Congress. And through that education campaign, I think we can take a more progressive approach in the regulatory environment and maybe mirror some of the progress that we're seeing out of Southeast Asia and Europe.
I was just going to add on the service to individual investors and the question of robo-advice. I do think the U.S. has been an early innovator, and we'll talk a little bit more about that when we get in the panel. But there is a global imperative driven by regulatory organizations to deliver lower cost financial services, more transparent value for money, more transparency, greater price effectiveness, greater value for money for consumers. So I think the combination of digital and advice in the financial markets is going to be an extremely powerful global force. And so I think it's only a matter of time between people before we read rueful articles about whether China is ahead or America is ahead. I will give you one example, though, where I think it is very much a sector-by-sector analysis. So I think unequivocally, China is ahead in the payment system, at least in the non-rural, the urban sections of the country. The American payment system is an abomination compared to other advanced countries, for those of you who try to scan things in various type places across the country, because of the fights between the banks and the retailers. But that's a very different marketplace, but that's a potential platform. That's a different marketplace today. It's segmented from the investment or asset management side, but I could see that convergence of banking and asset management, giving, for example, China an advantage in mobile access to low-cost investment advice.
I would also just, one thing from earlier is just say that, we are, in the US, I think the best at capital formation, without a doubt. And so that's why companies want to come to the US. They want to list on our markets. And with that, we know today we have the top 5 by market cap technology companies in the US. And if you look at the list of the top 10, I think we have 7 of the 10. So we're coming from a position of strength, and it's ours to lose. So how do we go about making sure that we are thinking about regulatory aspects to have the investor protections, as you mentioned before, and do things in the right way? We just can't be too far behind that, right? And so we need to take our lessons from other markets and make sure that we can still set the bar really high. And I hope that people understand that. Like, when we're doing innovation, it's not that we're afraid of regulation. We actually, for Gemini, we like regulation. Just give us clarity on it. Tell us how high the bar is. We can actually help, I think, markets in general by setting that new bar. And we're more than willing to do that. But we don't want to miss our lose our place in the U.S. Because we do it really well here.
I think it's well said that clarity is beneficial for everybody, both the investor, the entrepreneur, and also ultimate users of this. But for our personal experience as we've been building out our G-Coin and the money transmission, we got approval in Dubai first, Switzerland second, EU third, Brazil fourth, and then right now we're approved in 33 states. So, we're not security, but, it's money transmission. So, yes, it's an asset. And so we have a lot more states to go. And this is 4 years of getting regulatory approvals. And so you think about the amount of money that's spent. And we're, just over halfway through, the US. And so, that's expensive and takes a lot of time.
I'm going to add one more thing on that, just because we have OCC here. You're also starting to see these derivative markets pop up in other countries, and they're very large, and they're unregulated today. But the amount of money that's going into them and the impact when there's volatility in those markets and how they impact the other digital asset markets is something that I feel like we need to be involved, so that we can help stabilize that and be the trusted platforms. And I'm not talking about Gemini just in general. I'm just saying us as a country and the companies that are involved.
Okay. Well, thank you so much. So let me just zoom in onto cryptocurrencies. So everybody always talks about cryptocurrencies. The truth is that crypto assets come in a number of varieties. So we have cryptocurrencies, we have stable coins, we have utility tokens, but it's not totally clear to the general public what they are. Can you just give us a very quick primer on the basic crypto asset classes?
Yeah, I can take that first. You want to go?
No, it's you.
So there's a reason we frame our business as crypto assets and digital assets, and it's exactly to the point that Alberto's making here, is that this is a spectrum of digital assets where we frame crypto assets as assets that are native to permissionless blockchains that are truly sitting on top of infrastructure that is decentralized with no central authority. And the types of capabilities that are required to custody those assets and interact and engage with those assets are fundamentally different from traditional assets that are being tokenized, quote unquote, and hosted on top of permissioned infrastructure or hybrid blockchains. So, when you think about stablecoins, you're thinking about a digital representation of a fiat currency on a one-to-one basis where some underlying collateral is basically backing that asset. And that idea of tokenization, which has kind of driven the emergence of stablecoins, is more broadly applicable across all asset types, including data. So we're not just looking at the tokenization of the ownership interests in physical assets, we're also looking at more broadly how do you tokenize assets across a physical and virtual spectrum. And in that space, we've seen a ton of traction in the market around tokenization of data and data as an asset, and how do you actually capture the value associated with data and effectively distribute that value to the data owners, data producers. And there was a comment coming earlier from Dan Draper that was looking at the implications of data. And how that plays out. And I think tokenization represents that broad spectrum.
I don't think we have enough time to define all the use cases, right? I mean, it could be an access, it could be an access coin, or any number of things. But I think it just highlights, as Rob was saying, is that there's a need for clarity, and a lot of our current regulatory bodies that we have in the U.S. It spans a wider set of questions than what they have traditionally been asking, and so it poses problems or challenges, and I'm hopeful that the U.S. can kind of overcome and be able to delineate clearly that is a security, that is a derivative, that is an access, that is, and it's a kind of a fear topic still in a lot of ways, and we've had this early on is that a number of banks would pull your banking lines and say, no, we can't do business with you because you're a blockchain company. I said, well, let me think about this. I stand for an immutable ledger that's clearly nobody can fake from an internal controls perspective. It's clearly auditable. And aren't those good things? And so, and we need to find a way to delineate what's good from a financial perspective and what's not, and what's kind of the wild, wild west. There's a lot of people like Gemini doing the right things in the right ways. And so, let's find a way to embrace those types of, that type of entrepreneurialism.
Great.
And just to highlight that one quickly is, for the assets that we list on Gemini, we're very focused on making sure that they are not considered securities, and that's mostly because of the regulatory framework that we're following, as well as our focus on not just retail but also institutional investors, which we think makes healthier markets when you have both sides of that market. And so that is the reason why we will not list some of the tokenized assets if we think there might be or there is not clarity regarding its security status. So it's an inhibitor.
So there's a little bit of extent to which the hype has not helped the focus on what these things are. So I'm the old guy here. I remember as a kid, there were two forms of paper currency in the United States. One was called a silver certificate, and one was called a Federal Reserve note. And the silver certificate you could actually take to the Federal Reserve and exchange it for a certain amount of silver. A Federal Reserve note had no physical backing. Now, currency today, in fact, over 99.5% of it has no physical existence. What's the difference between a digital asset and a dematerialized security, right? India hasn't moved big piles of securities around for about 20 years now. Aren't those really digital assets? Federal Treasury securities in the United States haven't had a physical manifestation. They're digital. They've been digital for 40 years or so. So I think there's really not that much that's per se new. We just need to think more creatively about how to apply the existing regulatory structures to these new innovative instruments. And one thing that would be extremely helpful in the currency area is if we actually had a central bank that would start issuing in the digital form. I know Canada thought about it. Canada thought about it for a while. They seem to have dropped that. China may actually be the first to do it.
Yeah, they're just coming out in the last couple of weeks.
Why not?
Yeah.
They are. So, I mean, the central bank issued digital currency space is heating up rapidly. You see the digital RMB coming to market in the next 6 to 12 months, pretty much guaranteed. There's questions about whether or not that will be collateralized by gold or some other type of asset. But the e-krona is about to be issued as well. And, we're focusing acutely on that space because central bank issued digital currency offers a transformative opportunity for the global economy. And has massive implications to the way that our global trade system works. And I would argue, and I think there's a lot of people that are crypto native, that CBDCs, central bank issued digital currency, will come to play much sooner than folks think. The US in that space specifically, there was traction and discussion around what a Fed coin might look like several years back. That traction failed as well, similar to Canada. But as you start to see countries around the world moving aggressively in that way, I would argue that the pace is actually going to accelerate. And there's focus. There was a paper that was put out by 2 IMF researchers over the last several weeks that was actually saying the US from the CBDC perspective is so far behind other countries in the world that there may be an inclination or opportunity to look at how the U.S. could adopt privatized stablecoins.
You're not going to be the reserve currency of the world if you don't go in that direction. it seems
Fully
to me.
agreed.
Yeah,
Fully agreed.
Yeah.
Okay.
Great point.
Okay, so let me ask John a more provocative question here, and then I want to see the reaction from the others. So you clear an incredible amount of contracts every day at OCC. So do you think that blockchain technologies will be a threat in the near future or in the far future for OCC? Like, will they be able to be quick enough in the future?
I think that so what does OCC do? OCC centralizes the credit intermediation process. So if you think about the traditional market where you have two counterparties that don't know each other, in order for them to transact, they have to alter their price for the perception of the other counterparty's creditworthiness. The central counterparty has one set of creditworthiness that's known to all of the market participants, and so the central limit order book can actually have a single price for a particular type of asset, and it doesn't have to get adjusted for the different creditworthiness, the different perception of creditworthiness of the other parties. So that centralization is based on having a trusted network. One of the most important pieces of our several lines of defense is the admission criteria to become a clearing member and the financial reporting that has to go on and our surveillance of that reporting that has to go on. I don't think that gets disintermediated by a distributed ledger technology. I do think that all of the post-execution, or many of the post-execution pieces of the process, can be a lot more efficient through a distributed ledger environment. And that's why we are spending quite a bit of time figuring out. We have a small, nascent, probably 15% of the market for intermediating securities lending trades in the United States. That is a bilaterally negotiated business, and there's a real opportunity for the advantage of distributed ledger technology. But at the end of the day, for particularly systemically important financial market utilities, the name of our game is not trying to predict who's going to be winners and losers. Because if we were good enough to do that, we wouldn't be working in this part of the business. We need to be able to enable the benefits of a central counterparty, which not every single market should have central counterparty intermediation. That, I think, is one of the hypes around Dodd-Frank that they got wrong. We need to enable the benefits where they are going to arise. And that's a fairly sharp technology investment kind of a challenge, I think.
I'll build on that. There's two pieces there. One is touching on that bilateral ability, and that's, I think we have to delineate to some extent understanding blockchain as an infrastructure technology from smart contracts as the ability to process in a decentralized capacity computing logic, right? So that bilateral communication can be facilitated through smart contracts and this whole emergence of decentralized finance. But the post-trade settlement space, to your point, has been a huge area of focus. I mean, there's been a ton of work. ASX took a leadership role several years ago in deploying this. DTCC is pretty far down the path as well. So I think you're going to see the productionalization of those post-trade settlement systems in the next 6 to 12 months in a meaningful way.
Okay, so let me now focus a little bit more on robo-advising, just for a second, for a question for you, Steve. So when I interact with individuals on the street, they think that robo-advising is this very, very sophisticated technology where the individual interacts with a machine that understands exactly what the preferences of the person are, what the desires are, and then implements a automated portfolio allocation that is really evolving as time goes by and it's catered to the individual. Is it really reality? Are we there yet, or do you think this is something that we're still far away?
Well, a lot of robo-advising is pretty basic because the part that's perhaps more speculative is that part you described, eliciting preferences in a sophisticated way. Because I don't think that problem's been solved either in the real world of financial services or in the empirical finance literature, how you actually identify people's true preferences. But way back when, so robo-advising probably began in the mid-90s with a company, many of you may know this name, Financial Engines, and Bill Sharp, its founder, which really, for the first time, allowed you in a 401k plan literally to hire someone through an algorithm. And there were hints of that. You know, they made, the way they inferred your risk tolerance, say, if you had signed up for them in 1997 when we first contracted with them, is they looked at your existing portfolio behavior to draw some inferences because they didn't have any data. They couldn't call you up and because they were robo. And then probably about 10 years later, there were a group of technology innovators who got kind of annoyed with their human resources departments because they would get bonuses, and if you went to the typical Silicon Valley human resources department and said, I need help managing my bonus money, which is always a problem, nice to have, right? The human resources department would say, well, there's this firm down the street called Charles Schwab, or this firm down the street called Morgan Stanley, and I'm picking two of a particular firm that I know. And they would just send them off, and technology people said, well, I don't want to get in my car and drive somewhere. I want to be at a desktop. So hence, Betterment, Wealthfront, et cetera. But I think all of them share in common some, that what they have done is, what's happening in general, and actually I think Anand referred to this in his discussion earlier about model portfolios, is this automation of the investment process. The replacement of, it used to be I would sit with you as my advisor and you'd magically pick stocks and bonds and mutual funds. And now it's all been sort of algorithmically determined in a more disciplined way. There's lots of variation, there's lots of customization, but it's really the investment process being made more algorithmic. So I think in that part is actually true. For example, in the Vanguard system, there are 5 glide paths, there are all these flags you can shift based on personal preferences. But it's all driven by an algorithm. The personal advisor is explaining the investment process to you. It's a hybrid system at Vanguard with a personal advisor as well as algorithm. They're not creating the algorithm by the seat of their pants.
Okay. So before opening the floor to question from the audience, I have one question for Brent. So. On top of being the founder and chairman of Emergent, you've been in private equity for a very long time. And so how does the valuation of fintech firms differ compared to traditional companies, if there is any difference?
Yeah, well, I guess thanks to Georgetown and attending here, I can start with probably a very fundamental question. Everything's cash flow based, and it doesn't matter if you're a venture or maybe even angel, or if you're all the way through to maybe something like infrastructure. And I think the real difference as you're going through that is that every model is going to be wrong. And the question is, to what degree is it going to be wrong? And maybe it's better, maybe it's worse. And if you're in more the infrastructure bucket, you're expecting a narrower range. If you're in the fintech side, you're expecting a wider range. Of course, you adjust that with the discount rate you use, and it should be more on parallel. But look, a venture investor often is running a portfolio where they're expecting 30% of their stocks or their picks to do exceptionally well, and that's going to carry a portfolio through returns, and you might have several write-offs in there. On the flip side, a kind of private equity or infrastructure investor, you're underwriting for 0 losses. You got to get your capital back in every deal, and otherwise you're going to drift your portfolio returns down. And so, you kind of bring it back, though, as cash flows and say, okay, the fintech investor is often a little bit more willing to give you the benefit of the doubt on some of your hockey stick assumptions, whereas the other guys are going to knock it down a fair bit more. So, okay. But both get it wrong.
Perfect. Should we start with questions?
Firstly, thanks so much for organizing today's event. My name is Leo. I'm an evening program MBA student at Georgetown, and my daily job is a data engineer in American Institution for Research. So currently, I'm in the education industry. However, this question is made sent for the future students who want to switch industries. I want to dedicate it to the fund industry, the mutual fund, the Vanguard, or any hedge fund as a quant strategy analyst in the future. However, during an interview with a previous expert before, he said the MBA student may not have the outstanding advantage compared to the PhD student who is in a specific machine learning or natural language processing, the research career. So today I want you to ask as a MBA student, how should I face this drama and use my next 2 years to give me a better chance to step into this industry as you guys. Thank you.
Well, I said there are a few of us talking last night and just about how intellectual curiosity just is incredibly important, and that's something that I know Georgetown embodies in a lot of the not just the program but the individual classes. And we're talking about certain aspects that are new, and you talk about smart contracts. It's a Solidity programming language. Not many people know it. It's certainly not taught in university anywhere. And so, the best thing to do is to get out, to learn, do internships, ask questions, just dive in. And it's important the tools you learn in school, but it's also important what you learn outside of school as well.
Yeah, I would follow up on that. I think that's exactly right. I think what you get out of your formal education, and before I went to business school at University of Chicago, I was a political scientist. It's not what you learn in school, it's that you learn how to learn. And that's something that you can have a passion about, as I do, and I think many of us do, and that's a lifelong experience. And if you think it's only in school, no, you need to understand certain principles about how things are expected to work. You need to be able to look at cases that don't correspond to that, and think about rigorously decision-making processes. And it really doesn't matter what the specific discipline is or how well you understand the math. It's really, as Stacy said, surrounding yourself by people who are better than you. Most of the human race is better at math than I am. That hasn't necessarily limited what I've been able to do.
We do a lot of hiring in these sort of analytical and research fields. And what's interesting to me is with the growing use of, let's say, machine learning and artificial intelligence, which, by the way, is not really some magical process. It's just, I got a degree in computer science as an undergraduate, so I'm just yawning when people come in and talk to me about algorithmic-based reasoning, because that's what I did 40 years ago. But I do think what we see is there's really heterogeneity of skills. So, for example, at Vanguard, we're hiring people who got PhDs in sociology and really didn't know what to do and spent 12 weeks at a data science boot camp. It's all you really need to do programming in R and build simple predictive random forest models or something like that. So we're hiring that kind of person. We're hiring PhDs. We're hiring quantitatively inclined MBAs for those types of roles. But again, I do think everything that everyone just said, there's the technical agenda, which is learn R or Python so you can get a job. But then there's a few machine learning techniques so you can sell yourself from a technical skills perspective. But all the other things, I think everyone talked about the human side. There's a huge emphasis, obviously, on emotional intelligence and teamwork and engagement with other human beings. And I think, and we look for that, by the way, with PhD candidates in finance as well as with MBAs and undergraduates. So you really have to balance both of those, I think.
6.
Yeah.
One of the problems we face is taking these new products and putting them into old regulatory buckets. What changes should we be making in the U.S. regulatory system to make use of the promise of many of these fintech technologies?
So I'll start on that. It seems to me that by its nature and the nature of our constitutional system in the United States, regulatory change, and particularly regulatory change that requires legislation, is a very slow process. So we think in the modern day we're frustrated. If you know the history of the Exchange Act, it was passed by Congress in 1934. There were virtually zero significant changes to that until 1975. So 40 years, nothing changed on the regulatory front with respect to one of the most important market structure pieces of legislation in the United States. One of the issues we face today is that our regulatory agencies simply aren't adequately funded. So if they had more, they have really bright people at the SEC, the CFTC, the various Federal Reserve and other banking regulators, but they don't have enough of those people, and consequently they have to prioritize, and they can't move things through as fast as they would like to. So one of the short-term things that could be done is better funding for the regulatory agencies that we have, and that would give them the opportunity to implement some of the ideas that the two commissioners in the previous panel were talking about. Unfunded or underfunded market regulators are not a contribution, and that's something that I think Congress ought to pay attention to, and I think it is it's a politically neutral topic. Both parties ought to be in favor of, until things change in the direction they want to change, at least fund the structures that we have so that we can all find ways to make the changes through the process that exists.
Well, I mean, there's a can of worms between kind of national and state laws across a lot of different parts of our financial systems. But even if you don't want to tackle that, how about using something simple? My kids are now in university. They had a common app, and they're able to apply to a bunch of colleges. Hey, can we have a common app that we can apply across all the states, instead of having to do it 50-something times? I think there's some practical ways that even if you don't want to tackle the regulatory, because I agree it's a very big topic. I invest in different emerging markets, and one of the things that I find is a lot of the countries have investment offices, and they will actually help foreign investors kind of work through the various regulatory landscapes. And why not have an investment office both for nationals as well as internationals, here in the U.S. So I'm sure, and maybe that's part of the funding, approach. But there's a lot of practical things that could be done without even having to change the regulations.
The Uniform Commercial Code was many years ago an example of that. It's not as uniform as it used to be, but that's what we need more of.
It's a good one, yeah.
Can I give you one practical example that relates to everyone here as sort of individual investors or savers, which is going back to the history of the Securities and Exchange Act, right? The idea was to create a document known as a prospectus, which would be reviewed by the financial advisor, attorney, or accountant for the client in this complex sort of information disclosure process. That mindset still dominates today. Yet we know that if I put a mutual fund or ETF on the homepage of the Vanguard group, I will get hundreds of thousands to buy that security, even though they had no intention of buying it when they arrived at our website, just merely by making it more salient in the digital customer experience. The orientation of the pages, the orientations of investment information, this is all basic behavioral economics for those of you who studied that. But those kinds of things, the regulators have not come to grips with. And so as long as we meet the standard requirements of FINRA and the SEC for, say, returns disclosure and information descriptions, and they're accurate, that's fine. But these broader questions of how the customer experience shapes decision-making is really beyond today the reach of, actually, I would say most regulators around the world. And by the way, they've begun to think about it because they're understaffed and they're under-resourced. They're not really sure how to approach the problem.
But you read every word in that Apple document every time you update your software, right? It's not just the regulatory environment, it's the legal environment as well.
That's right, exactly.
Yeah, I also find it really interesting to see some of these newer fintech companies who do have regulatory, maybe be statewide or whether it's otherwise, how they're starting to approach their end customer. And instead of giving them the list of paperwork, they're walking them through pages on the website that have pictures and show them and have little funny, sayings and things that get them really interested and helping them understand what they're going through right there and how that investment might work, the risks associated with them, in a funny way that really grabs the investor. And I think it actually helps them better understand what they're investing in.
Okay, well, thank you very much. I think we're out of time. Let me thank the panelists.
All right, everybody. So this concludes our program today. And so I want to thank you all for coming. This was just a wonderful example of, I think, what Rena wanted to build 10 years ago when she started the center, which was a place to convene, create great dialogue, and get to surface issues, get the conversation, engage the policymakers, the regulators, and industry together. So I think it has been great. So you've been an absolutely great audience. We're not done yet. Those guys still had some questions to answer. We're having a happy hour upstairs, a reception. So please join, and other speakers are still here too. Please join us upstairs. This is, the 2019 event. We'll be contacting you soon about the 2020 event. And we have the blockchain one already scheduled in March. We'll do our big financial markets quality again next fall, probably early November. We'll get that date out to you soon. But, and as always, if you have any questions, comments, or thoughts, please reach out to myself, Rena, Anna. We'd love to get your feedback, et cetera. But otherwise, thank you very, very much. And we look forward to seeing you next year.